Hello, Smarties, and welcome back to Smart Real Estate with Westcliff, the podcast where we help you learn, invest, and manage your real estate investments with confidence. I'm your host, Addy Saeed, and as always, I'm joined by my insightful co-host, Jaffer.
Thanks, Addy. Today we're continuing Series 4, Personalized Investment Opportunities, and this episode is all about portfolio diversification options. If you've ever wondered how to balance risk and return across different asset types, markets, and even investment structures, this episode will give you the insights that you need.
Exactly, Cass. Diversification is not just a way to protect your investments. It's a strategy to enhance returns and unlock opportunities you might have not even considered. Today, we'll talk about diversifying through direct real estate ownership, alternative investment vehicles such as income trust, and co-investing through GP-LP structures. Let's dive in. So let's start with the basics. Diversification means spreading your investment across different asset types, markets, and strategies to reduce risk. In real estate, this could mean investing in residential, commercial, industrial, or mixed-use properties.
That's right, Addy. But diversification doesn't just stop there. It also includes how you invest. For example, you could own a real estate directly, participate in income trusts, invest in syndications or co-investments structured as a general partner, and limited partner arrangements.
Exactly. Direct ownership is the traditional route, buying a property and either managing it yourself or hiring a property manager. It gives you full control, but also comes with responsibilities including team management, maintenance, and debt.
On the other hand, alternative investment vehicles like real estate income trusts or REITs allow you to invest in real estate without the hassles of hands-on management. These trusts pool investor capital to buy and manage properties, and you earn income from rents and other revenue.
And then there's co-investing using GP-LP structures, which is one of the most efficient ways to diversify. In these arrangements, the GP, general partner, often experienced real estate firm, manages the investment, while LP contribute capital and enjoy a share of the profits without active involvement.
Exactly. GPLP structures are especially powerful because they allow investors to access large-scale projects like multifamily developments or commercial properties, which might be out of reach individually. Addy, can you explain further how this structure can be used to help investors diversify?
Absolutely. An example would be a GP-LP partnership setup for a multifamily development in a growing suburban market. The LPs contribute most of the capital, while the real estate firm, as the GP or general partner, guarantees the debt and manages everything from securing permits to overseeing construction and leasing. The result was a high-performing asset that delivers strong results for returns for all partners.
And by combining different investment approaches, direct ownership, income trusts, and GPLP co-investing, you can build a diversified portfolio that balances risk and return across various markets and strategies.
Another key aspect of diversification is geography. By investing in properties across different cities and regions, you can mitigate risk tied to local economic downturns. For example, while one market might be facing a slowdown, another might thrive due to population growth or new infrastructure investment.
And let's not forget diversification by asset type. For example, you might invest in multifamily property for steady cash flow, an industrial warehouse for long-term stability, and a retail plaza for potential upside. Combining these helps reduce dependency on any single market segment.
Absolutely. It's also important to diversify investment timelines. Balancing long-term strategies like rental properties with shorter-term opportunities like flips or development projects can provide both immediate and sustained returns.
And tax benefits, which is my favorite, are another reason to diversify. Different asset types and investment structures offer unique tax advantages. For example, REITs, or real estate investment trusts, typically provide distributions that may be tax efficient, while direct ownership allows for depreciation write-offs.
Exactly. At Westcliff, we specialize in helping investors create tailored portfolio that include a mix of direct investments, alternative investment vehicles like REITs, and co-investment opportunities through GPLP structures. This approach ensures that your investments are balanced and aligned with your financial goals.
So whether you're a seasoned investor or just starting out, diversification is key to building a resilient portfolio that performs well in any market condition.
Thank you for joining us for today's episode of Smart Real Estate with Westcliff. If you're interested in exploring portfolio diversification options, whether it's direct ownership, REITs, or co-investing with Westcliff, visit our website at www.westcliffam.com/listen or give us a call at 647-799-2264.
And remember, Westcliff is here to support you through our unique learn, invest, and manage approach. Let's work together to turn your goals into reality. Subscribe to the podcast, follow us for more insights, and reach out anytime.
And as always, please remember our disclaimer. While we are professionals, this podcast is for information and entertainment purposes only. The advice shared may not apply to your unique situation. Always seek personalized advice from a qualified professional before making any investment decisions.
Thanks for tuning in, Smarties. In our next episode, we're going to dive into luxury and niche real estate investment opportunities in high value and specialty markets that can elevate your portfolio. Until then, happy investing.
See you next time.